Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. Much has been written in recent years about the retail apocalypse. Earlier this year, we shared the mind-numbing statistics of retail store closures that amounted to over 10,000 retail stores in the U.S. in 2019. The pandemic clearly has not helped most retail establishments. And on today's show, we're taking a closer look at what's likely to happen in retail. These days, my email is inundated with listing offers for retail real estate. They aren't bargains for the most part. I'm seeing pharmacy locations, banks, fast food establishments, convenience stores, gas stations, automotive service shops like muffler and tire shops. The list is long and varied. These for sale listings are not bargains at all. I recently saw an offering for a 20,000 square foot multi-tenant property that houses 4 large restaurants. The asking price was at $588 per square foot, well above replacement cost. The seller argued that was a 6.5% cap rate. Now remember, these restaurants have been closed for quite some time. The metrics for restaurant dining post-pandemic have not been established. It would be very hard for this investor to pay that kind of top dollar with the risk that's inherent in 4 new restaurants as tenants. Simon Properties is the largest shopping mall owner in the U.S., and in the past 4 years, Simon has acquired 3 of its tenants. And now they're in discussion with Brookfield Property Partners to potentially acquire JCPenney. And JCPenney, currently in bankruptcy since May, is an anchor tenant in several of Simon's shopping malls. When a mall loses its anchor tenants, the mall usually dies. So it's not surprising that Simon is looking at buying one of their tenants. If you have the depth of pocket to do that, that's great. But increasingly, commercial landlords are becoming partners, if not outright owners, in the retail businesses that occupy their space. At least one large retail anchor tenant renegotiated their lease from a fixed-price triple net lease to a variable lease that's calculated according to a formula linked to retail sales. You see, our credit system isn't designed to handle an economic downturn. There's so much debt in the system that businesses can't survive a drop in revenue. The businesses have borrowed money to fund their inventory, they've borrowed money to advance funds for their accounts receivable, they've borrowed money to pay for equipment, or perhaps the equipment's leased, but either way the fixed costs of these retail businesses is high, and the businesses are not resilient to economic fluctuations. The problem is further compounded by the fact that the mall owner can't survive a long period of economic vacancy either. As a commercial landlord, I frequently face questions from tenants looking for rent concessions to help them with revenue fluctuations. The massage therapy office that rents from us needs a rent relief. The clothing store needs rent relief. And we know that some stores will close as a result of the pandemic. Some stores simply won't survive. Here's the scenario that I believe we're going to face in the world of retail. Retail space will get repriced on a massive scale. And there's going to be a lot of pain along the way. Even those retail owners with firm leases will find themselves renegotiating rent concessions on a large scale. Now let's imagine we've got a 20% reduction in retail floor space as a result of the combination of the pandemic and the ongoing trend of local retail sales being replaced by online sales. There might have already been a 10% vacancy rate in the market, so to that you're going to add another 20% of new vacancy, and you're close to 30% vacancy. So now, some of those properties go into default on their loans, and the buildings are sold at a fire sale price, say 50% off of their construction cost in a foreclosure auction. The new buyer owns these buildings at 50% of their replacement cost, and the new owner can charge a lot lower rent compared with the competition and still make a healthy rate of return. The tenants will flock to the newly available space that's priced at maybe a third less than the comparable market. Tenants in the existing spaces will also renegotiate their leases. They're going to argue that the move to less expensive space is necessary for their business survival. The existing landlord faces a difficult choice. The landlord either offers a rent concession to match this new low-priced space, or they lose the existing tenant and revenue goes to zero. It's a lose-lose situation for the landlord. This is a scenario that will play itself out over and over again all across North America. Even a small amount of new vacancy will result in a large-scale renegotiation of commercial leases and rent concessions. And for this reason, I believe retail space is going to be repriced below construction cost in the coming months. And for those who own retail space, my prediction is probably heresy. But my prediction is based on first-hand experience. You see, I just accepted to rent about 4,000 square feet to a tenant at below market rents in order to fill the space. I looked at the competition in the area, and there were more than 15 empty vacant locations within walking distance of this location. All other things being equal, I would have a 1 in 15 chance of leasing the space. And since there aren't likely to be 15 new tenants anytime soon, we faced a simple choice. Do we want some revenue for the next couple of years in that location, or do we want zero? Now, if other tenants find out that I lease the space for $5 a square foot less than they're paying, chances are that they too will demand a rent price reduction. So for that reason, I don't believe we need a retail apocalypse to result in a significant repricing of retail commercial space. As you think about that, keep an eye out for bargains. Have an awesome rest of your day. Go make some great things happen. I'll talk to you again tomorrow.